Welcome to the deep dive. Today we're tackling the UK housing market. It's sending some seriously mixed signals.
It really is.
Yeah, are we looking at just a bit of a slowdown, maybe a necessary correction, or something bigger, like a crash potentially on the horizon? We've got sources pointing every which way.
Absolutely. And that tension is front and center in the latest data. Halifax puts the average UK house price at 298,184 ADs,
Really?
so just shy of that 300-pound K mark.
Okay.
But the key thing is the trend. The annual growth has really slowed down. It's now just 1.3%. That's actually the slowest rate we've seen since April.
Wow, okay.
And month on month, well, year on year to September, prices actually fell by 0.3%. So stagnation is maybe putting it mildly.
Right, a definite cooling. So let's dig into that pessimistic view. First, the case for a proper decline, the bear thesis. What's driving this? Why didn't we see that usual market bounce after the summer?
Well, that hoped-for post-summer bounce just didn't happen. Plain simple. Rightmove's data shows growing caution. Fewer new buyers are making inquiries. And interestingly, fewer sellers are putting their homes up for sale, too. It's like everyone's hitting pause.
And the slowdown isn't uniform, is it? Some areas are feeling it more.
Exactly. It's particularly noticeable in those higher-value spots. London, for instance, some iconic neighborhoods like Somerstown, Abbey Road, have seen staggering drops, almost 50% since 2019, according to some reports.
50%.
Yeah, quite dramatic. And more broadly, the south of England is cooling that. The southwest saw prices dip 0.2% year-on-year to September. It's a definite stutter.
Okay, so caution is one thing, but what are the big sort of structural forces pushing prices down? You mentioned interest rates earlier.
That's the big one. High interest rates.
Yeah.
It's creating what some are calling this slow-motion car crash scenario.
Right.
You've got millions of households coming off cheap fixed-rate mortgages they took out years ago. When those deals end, they face potentially huge jumps in their monthly payments.
Which obviously hits demand hard and might force some people to sell.
Precisely. It squeezes household budgets, reduces borrowing power, and could push more supply onto the market just as demand weakens.
And it's not just interest rates, is it? The sources also point to government policy, tax changes.
Yeah, the chancellor's moves on second homes and non-domiciled individuals, that's playing a part too. Higher capital gains tax, stamp duty changes, council tax increases, it's all adding up.
Making it less attractive to own multiple properties.
Definitely. It's basically encouraging second homeowners to sell up, particularly hitting rural markets where second home ownership is, quite prevalent. More supply again.
So you combine that, the debt risk, the tax pressure, a generally sluggish economy. It sounds like a recipe for falling prices, maybe even a crash.
It certainly paints a concerning picture.
But then, and this is the really confusing part, you look at the professional forecasts and they're actually quite optimistic, more so than last year even. How do we square that circle?
It's a huge contradiction, isn't it? But yes, the consensus among major forecasters is that prices are actually expected to rise next year and beyond.
Really? Like who?
Well, Savills, for example, is predicting 4% growth by 2026. Halifax thinks prices could rise by up to 3% next year. Even the typically more cautious ones like Zoopla and Rightmove are forecasting slight growth, maybe 1% or 2%.
Okay, so after all that doom and gloom, why the optimism? What are they seeing that might prop the market up?
There are a couple of potential supports they're likely factoring in. One is the possibility, and it's still just a possibility, of the Bank of England cutting interest rates again, maybe later this year.
Ah, okay. Easing the pressure a bit.
Exactly. And the other factor is signals that the government might be leaning on lenders to loosen those strict affordability rules that have been holding back buyers.
Right, make it easier to actually get a mortgage.
Potentially, yes. Injecting a bit more demand back into the system.
So we've got this strange situation. Current data looks weak, maybe even worrying, but the forecasts are looking brighter. What does this actually mean for someone thinking about buying or selling right now?
Well, could suggest it's created a bit of a buyer's market. Buyers who are serious, who are in a position to proceed, they seem to have more negotiating power. They're apparently being quite aggressive on price.
Makes sense. If sellers are nervous and there are fewer buyers overall.
Exactly. So you have today's reality, the slow data, the price falls, in some areas clashing head-on with these longer-term, more positive forecasts. It creates real uncertainty.
Which leads us to the final thought we wanted to leave you with. We know moving home isn't quick. It typically takes, 6 or 7 months?
Well, at least, yeah.
And lots of people, homeowners especially, seem to be waiting right now, holding off maybe until after the autumn budget to get more clarity. So here's the question for you. If you're a serious buyer, what's the trade-off? Do you wait for that certainty whenever it comes, but potentially miss out on the chance to negotiate hard in this uncertain market? Or do you jump in now?
It's a tough call. Wait and risk prices rising, or act now while there's maybe more flexibility but less certainty, something definitely a mull over.